Great. Hi, folks. Good afternoon and welcome to this edition of Marcellus's webinar on Rising Giants, our mid-cap portfolio. I'm Pramod Dubey. I have with me my colleagues Saurabh Mukherjee, our CIO, and Ashwin Shetty, the portfolio manager of the Rising Giants portfolio. So it's been a while since we did a webinar on this portfolio. Today, we would look to cover the usual piece in terms of how has the earnings performance of the portfolio companies been in the recent past, and how do we see the coming few quarters and years in terms of fundamentals for these businesses. And as many of you might have noticed, we have made quite a few changes in the portfolio of late. We'll be talking about those as well. So to talk about them in more detail, I'll hand it over to Ashwin. Over to you, Ashwin.
Thank you, Pramod. Good evening, ladies and gentlemen. Hope all of you are doing well. So let me bring up the presentation. Yeah. So just to recap the journey of Rising Giants, PMS. So this portfolio was launched on 27 December 2021. And this slide summarizes the earnings performance of the portfolio companies as well as the return of the portfolio. So we'll find that there is a bit of a disconnect between the two. So the gray bars in the portfolio, they represent the earnings performance. You'll find that they have been consistently up. And for many of the quarters, they are into positive YOY growth. But when you look at the blue line of the portfolio returns, you will find that that has not been great. And especially during the first 15 months of the launch of the portfolio, you will find that the earnings even touched 40% at one point in time, YOY growth. But the portfolio actually fell down between December 21 to March 2023. We will talk about the disconnect in a little bit more detail. Having said that, since April, the portfolio has recovered from the lows of March 23. So since 1st April 2023, the portfolio is up 23%. The earnings have continued to be around the double-digit mark. And just to take this point forward, if it is one thing that has impacted the return of the portfolio during its life cycle is this particular drop in the PE re-rating, the 1 year forward PE. So when the portfolio was launched, at the time, the 1 year forward multiple of the portfolio was close to 49. That dropped all the way to 36.2. So these are based on the earnings of the portfolio companies as existed at that point in time. So some of these companies would have been exited and some new companies would have made into the portfolio. But if I had to point out one big challenge that we saw in this portfolio was this massive PE rating in the first 15 months of that launch. Having said that, again, in the last 15 months to last 13 months, we are seeing that the PE has kind of stabilized and it has in fact slightly re-rated. And so another way to,
Ashwin, if you don't mind, just go back, Ashwin. So folks, just to sort of help you rationalize, turn this into your portfolio statement, right? You'll be getting statements from us every month, and you'll be seeing that even if you invested with us, I think 2 years ago, if you invested with us 2.5 years ago, you will still be -2, -3, -4% in terms of your NAV, right? You'll be down since you invested. So just to help you understand that, if you take the last 2 years, earnings growth roughly has been around the 10% mark for the portfolio. But that 25% derating, if you annualize that, the portfolio over a 2-year period would have derated at around 12-13%. So even though earnings are growing at 10%, the PE derating on an annualized basis is roughly 12%, and 10 minus 12, you're getting the -2, -3% return. So the PE derating that Ashwin is showing you here, where his red cursor is hanging, that 49.1 becoming 36.2, that PE derating is what absolutely hammered us in the first 15 months of the portfolio's life. And that call, right, ultimately I as the CIO am responsible for that call. The fact that we entered this portfolio, we launched this portfolio in the closing months of 2021 and the opening months of 2022. All of Marcellus's portfolios, whether it's CCP, whether it's LCP, whether it is RGP, in that 15 months starting Jan 22 to through March 15, all of our portfolios were hurt badly. RGP was hurt the most badly of the lot. And since then, we'll discuss the recovery since then. But looking back, Jan 22 was a wrong time to launch anything. given that it was the peak of the PE cycle for all our portfolios and indeed for the stock market. That decision to launch RGP in the closing months of 2021 and the opening months of 2022, I think that was my call, and in retrospect, that was a wrong call on my part. Carry on, Ashwin.
Sure. And this is also visible in when we look at the stocks that have seen the maximum drawdown in the portfolio. You will find that while there have been stocks, where the earnings have been weak, and that has justifiably translated into weak share price. But when you look at the stocks on the right-hand side table, you'll find that there have been many stocks in the portfolio which have delivered very, very healthy earnings growth. In fact, one stock has delivered 265% earnings growth over a 2-year period. Even for the stock, actually, we have seen the share price in the negative zone. So this kind of also corroborates, that the derating impact that we have seen in the portfolio. Having said that, as I said, the portfolio has been looking up since the lows of March 2023. So we are up, the portfolio NAV is up 23% as of yesterday evening's numbers. And there are two important drivers of this recovery. One is that the same set of stocks which saw one of the highest drawdowns during FY23 period, they have contributed handsomely to the returns in the last 1 year. So some of these names like Dr. Lal, Astral, and so on, they were amongst the stocks that performed poorly in the portfolio in FY22. FY23, and that we have seen the recovery in the share price return of these stocks in the last 12 months, and they have been also been backed up by the improvement in the earnings growth for these companies. So this is good news that we have been emphasizing around.
Just to be clear, Ashwin, I think worth explaining what TTM means. Not everybody will know what TTM means.
So TTM is trailing 12 months. So many of these companies, if not all of these companies, have reported their the latest quarter reported is December 2023. So what we have done is that we have taken the last 4 quarters, that is Jan 20 calendar year December 23, and compared the return with the calendar year 22. Basically, that is how we calculate the trailing 12 months, or basically the last 4 quarters cumulative earnings for the company, and compare it with the preceding 4 quarters cumulative earnings for the period. So that is one thing. So we have been, in fact, emphasizing in our road shows, etc., that for many of these companies, this is not structural in nature. We were hopeful and confident that many of these stocks we will see a recovery, and that has played out actually. That has played out. However, there is and second important driver of the recovery is what Pramod touched upon, that we have made a lot of portfolio changes over the course of last 12 months. So this is the portfolio additions till from 1st Jan 2023 till the 31st March 2023. There are also a few changes which we have been doing in the month of April that we will get to know in the statement of when you get the statement in the early part of May. But broadly speaking, we have added 12 names in the portfolio in the last 15 months. And the good news is that the strike rate of success has been pretty good. So you will find that the negative returns, the portfolio, the companies that have delivered negative returns since the entry, that is only about 1/3 of the portfolio, whereas 2/3 of the new additions have actually delivered very good returns. In fact, some of the companies like Trent, etc., have actually gone on to deliver very, very superlative returns since the time we added to the portfolio. In fact, Motilal Oswal, which we added around a month back in the portfolio since our additions, that has also delivered very good returns in the portfolio. So this also gives us confidence that we are on the right path in terms of making the necessary portfolio changes. So they are delivering positive returns to the portfolio. But also importantly, the fundamentals of these companies are also delivering. Ultimately, if the fundamentals fail, we believe that the returns will also fail. So thanks that the earnings growth of these companies also, on an average, very, very good for these new additions that we have made. Having said that, there are a few stocks, some of the stocks which we have bought since the inception of the portfolio, where we are yet to see a recovery in the earnings as well as the share price. But we continue to hold. We believe that good times will come for these companies as well. And what gives us confidence for holding these companies is, we will talk about that. I think some of the companies we discussed during our last month's little champs, which are common with that portfolio. For example, Alky Amines, why we continue to like is that historical performance of the companies have been very, very consistent. So despite being in a commodity industry, if you look at Alkyl's journey over the course of last, if you leave aside just last 2-3 years and reflect on its journey over the course of 20 years, you find that the company has been very, very consistent performers. In fact, the maximum drawdown in the YOY PAT that we saw for Alkyl was only about 1% in the last 10 years. But what happened is that because of the COVID, these earnings actually saw significant volatility over the course of the last two.
I think Ashwin, worth explaining why historically Alkyl's profitability had such stability. It's worth explaining that. Thank you.
So Alky Amines primary one important aspect that lends consistency to Alkyl's earning is that the end user industry is pharma. And pharma, at least the volume side, tends to be very, very stable, if not the pricing side. So one of the important end user industry is fairly stable. People, irrespective of whether it is bull market, bear market, people will consume medicines. So the volumes of the end user industry is pretty predictable. Secondly, Alkyl amines main chemistry is amines chemistry, where it is a duopoly in India. So only Alkyl Amines and Balaji have been able to crack the amines chemistry in India. So there are a lot of competitive moats around it because it's a very hazard. Because ammonia is the base for manufacturing this product. It's a highly difficult to make product. Basically, you have to have a significant robust process engineering capability in place. Plus also methylamines and ethylamines are very difficult to transport. So as a result, these chemicals historically were not impacted so much by imports. So there is no influx of imports into this industry. So duopoly nature of the industry plus fairly stable end user industry and no volatility because of the imports. So as a result, if you look Alkyl's gross margin, it's been fairly trades in a very fairly narrow range. See, if I'm not mistaken, 48 to 52, 53% throughout its history. But what rendered volatility to this company is that one of its product, acetonitrile, which was relatively a small contributor product till 3 years back, it found a roaring success during the COVID period. Chemical is called acetonitrile. So it found application in COVID-related drugs. And at the same time, China was out of the market during COVID period because of the lockdown in the country, etc. So as a result, the demand for acetonitrile rose, whereas the supply actually in the global market it declined. So as a result, the acetonitrile realization, because of the demand supply imbalance, it significantly increased. So what used to be a 200 rupees per kg product, it went up all the way to 400 rupees per kg. So as a result, we saw very strong volumes, revenues, as well as margin boost in FY22, FY21. But as the COVID cases, actually disappeared from our lives, so the demand as well as the realization for acetonitrile came down significantly in FY22. And hence, you will see that in FY22 there is a drop in the earnings for Alkyl. As things were stabilizing in FY23, what we saw, especially in the last 6 to 8 months, is that there is a huge imports coming from China of acetonitrile. So acetonitrile is one chemical which, unlike Alkyl's historical core product of methyl and ethyl, this is relatively easy to, it's a relatively stable product, relatively easy to import and transport this over a large distance. So Chinese have been present in this chemical. But what we saw in the last 6 to 8 months is the significant import as well as significant price correction in acetonitrile. So again, during pre-COVID, it used to be 200 rupees per kg, went up all the way to 400 rupees per kg. And what ideally the prices should have reverted back to 200, it went down all the way to 120, 110 rupees per kg because of this dumping from China. So as a result, we were expecting that things will recover in FY24 as everything normalizes. But this import actually came out of the box, and it actually impacted the earnings of the company. Having said that, why we continue to hold is that we think FY25 will be a good year for Alky Amines. So we are seeing in the last 3 months, especially since November 23, that the price realization of acetonitrile, albeit at lower levels, but they are stabilizing. So they are no more going southways, which was the case in the early part of the year. And we are also seeing the input volumes are actually declining every month now. So as a result, we believe that acetonitrile volumes as well as realization, we should see a very good improvement to alkyl. And as a result, the margins and revenue should go up. And secondly, recently also there is we come across the news that there is an anti-dumping investigations which has been opened up on acetonitrile imports from China and certain other countries. Even though we are not keeping this in our base case, but any positive outcome of on this front can actually positively surprise.
I think just to sort of lay that out, folks, Alkyl complained to the government of India that the Chinese were dumping acetonitrile, and then as Ashwin said, the government of India announced that they were investigating. The government of India announced that they were investigating the matter. So if after the elections the government indeed announces that Chinese acetonitrile will no longer be allowed to enter India, that's roughly 30% of Alkyl's profits back into the picture. So those blue lines, the blue bars in Ashwin's chart, which are going downwards at minus 39%, 9-month FY24, that automatically gets cancelled out because roughly 30% of their profits used to come from acetonitrile before the Chinese started dumping. And in a way, this is our job, right? Our job is to identify champion franchises doing the right thing. Acetonitrile is an essential chemical. Aliphatic amines are essential chemicals. This is the liquid bit of your dawai. This company is the most efficient maker of aliphatic amines in the country. It's the most efficient manufacturer of acetonitrile in the country. Right? These are essential chemicals you and I needed for our dawai. They have consistently increased capacity in the last 3 years, in the last 10 years, in the last 15 years. It's a highly profitable firm. Now, if the Chinese come and dump, as they have done through 2023, and Alkyl loses that entire profitability, that 1/3 of its profits that come from acetonitrile, should we dump the shares and run away? Our submission to you would be that's not investing, that's just panicking. We've stayed invested, and as Ashwin's box, the way ahead box on the right-hand side describes, it finally looks that there will be redressal. It finally looks like there will be redressal from the authorities as they stop the Chinese material from coming into the country.
Yeah. And moving to Page Industries, more or less similar story to Alky, though in different products. So Page Industries, again, very pristine franchise. If you look at the historical financial performance, I think very solid performance. However, during COVID, actually, again, it saw a way of positive, very positive development, and then a negative development followed. What was positive development is that the athleisure sales of Page Industries rocketed during COVID. That was primarily because all of us were working from home, and hence, instead of wearing office formal wears, actually we were wearing more of athleisure and stuff. So the sales rocketed for Page Industries during this work from home era. But again, as everybody started returning to office, this demand actually started tapering down, especially from second half of FY23. And that has continued because we are again optically comparing to the high base of last year. That is the first half of last year, fiscal year. So optically, the base is high, and the demand has definitely gone down than what used to be during the COVID work from home era. It's also channel destocking at the distributor, at the retailer level. So that is adding another layer of impact on the athleisure sales. And generally in the broader innerwear category also, we're finding that channel destocking is happening since the last 6 to 12 months. So that is adding to the pain. Again, why we continue to hold the stock is because we think it's kind of a king in its products. Actually, very high aspirational product, very strong historical performance. And secondly, we also believe that over the course of last 5 to 6 years, Page has built many new growth drivers. For example, the women's and kids wear. Historically, Page was not very strong in those segments, but over the course of last 5 to 6 years, it has built very good brand appeal in those segments also. And these in the next 4 to 5 years, these segments can also contribute handsomely, whilst the base men's innerwear products sales recover. So we continue to hold Page Industries in the portfolio. And two stocks where actually
I think
there has
just
been
on
no...
Page, Ashwin, I think it's worth acknowledging on Page that whilst, just go back, Ashwin. So
Yes.
whilst on Page, not just the FY 15 to 20 numbers, folks, not just the FY 15 to 20, even if you looked at the 10-year numbers, 2010 to 2020, Page was a company which was a smooth profit machine. Revenues and profitability had grown at a pretty steady rate. They had the first wobble was 2017. 2017, Aditya Birla and Van Heusen put up a good fight against Page, and roughly for 5 quarters, Page's revenues flatlined. So we remember, a particularly tough meeting with the management in the summer of 2020. No, summer of 2019. Yeah, summer of 2020 was COVID. Summer of 2019, I remember a very tough meeting with management where we were saying, what are your plans to pull out of the revenue funk? And to give the management credit, they recovered from that fight with Van Heusen. They sorted out their distribution issues, improved product quality, and had a bumper COVID. Right. So just if you contextualize this is a company which for 15, 16 years, coming into COVID and through the first year of COVID, did an excellent job. FY 2022, as Ashwin is showing you, FY 22 was an epic year for COVID, for Page. We all sat at home, as Ashwin's explaining, we bought athleisure. Our job at that stage, after having seen how well Page had done in the year to March 22, in the summer of 23, we should have, in the summer of 23, we should have, in the summer of 22, I'm sorry, in the summer of 22, summer of calendar year 22, we should have pulled the position back and taken either a very small position or got out of it altogether, because that COVID surge, where Ashwin's cursor is at the moment, the red cursor, that cursor we knew, everybody knew wasn't sustainable. And I think our unwillingness to pull out of Page in the summer of 22 has cost you money. It's a small position in the portfolio now, but it should have been a small position in the portfolio 2 years ago. And that was a mistake that we have learned from, right? We have learned that when you can see that a company has done exceedingly well, you need to throttle the position off, because the earnings can't sustain. And Ashwin will talk to you in the subsequent slides how we have applied that learning to recover in RGP. Much of the recovery in performance in the last 12 months has been learning from this mistake that we made, where excellent company Page over-earned through COVID. We should have pulled the position back in the summer of 22, and our unwillingness to do that was a mistake on our part. Carry on, Ashwin.
And the next stock is GMM Pfaudler, where actually the company delivered very, very good earnings growth. It always been in the history, at least since FY 15. And through FY 21, 22, 23, the earnings growth continued to be top notch. In fact, much better than historical rates. In fact, this minus 38% for FY 22 actually is a one-time impact. If you adjust for that, actually the growth in earnings would even be good for FY 22 as well. But the stock actually went all the way, stock price actually went all the way down through this period, despite the strong profit delivery. So there is a massive, if one stock in the portfolio which has seen massive derating over the last 3 years, is GMM Pfaudler. But in 9 months FY 24, of course, the company has seen some challenges because of the broader slowdown in the chemical space. So GMM's glass and equipment, the biggest end user industry is chemical industry. So following the broader slowdown in the chemical industry, GMM's product order book has also witnessed impact. And obviously there is a negative operating leverage which has come into play. But having said that, again, here we believe we continue to hold GMM Pfaudler. One is that we are seeing improvement in the order flows. The management commentary in the third quarter results indicated that there is an improvement in the order intake, which is happening. Plus, over the course of last 4 to 5 years, GMM has also built many more growth drivers than what used to be one product, one country company. So 5-6 years back, GMM Pfaudler was essentially one product, glass-lined equipment, supplying to Indian market. But now GMM is much more diversified, both from a product perspective as well as from a country perspective. And one segment where actually we think it is making good amount of traction is the mixing systems. Globally, mixing system is as big, if not bigger, than the glass-lined equipment. And through both inorganic as well as organic focus, GMM is actually making a good inroad into that system, into this segment. And we believe that over the course of next 4 to 5 years, this can contribute handsomely to both revenues as well as profit of GMM Pfaudler. And of course, the PE of the stock, as I said, has come off significantly. So again, we are expecting both improvement in the earnings going forward for GMM Pfaudler, as well as a bit of re-rating in the price to earnings multiple.
Also, worth adding, one of their competitors has gone bankrupt. So that's always good news when you're backing the most efficient player in the sector, the player with the largest market share globally. If a competitor in India goes bankrupt, that means reduced competitive intensity, which means greater pricing power. And as Ashwin's saying, not only are they selling the vessel in which the specialty chemical or API is made, but they also, through acquisition, bought the technology for mixing. So they literally think of a blender or a food processor and the chemicals going around and around. So GMM Pfaudler can not only now sell the vessel, but also the mixing system. They already had, from a 2008 acquisition, the drying solution called Mavag. So from being 3 years ago a company that just sold reactors, glass-lined reactors, the ceramic vessels, they are now a solutions provider which can set up pretty much the entire pharma plant. And the good news is one of their competitors has gone bankrupt. This is a company where operationally we don't have concerns. Business, the franchise is in great shape. Unlike Page, where there was over-earning, there's no reason to believe there was insane over-earning here. As the China +1 situation plays out, as APIs in India, as the chemical industry in India recovers, this company should be a mega beneficiary. Back to you, Ashwin.
Yeah. The last company here is Aavas. Again, here you'll see that the earnings actually is as consistent as it gets actually. So again, very, very strong historical track record, very good underwriting practices, and has been a beneficiary of the affordable housing tailwinds that we have been seeing over the last 3 to 5 years. The only problem that happened in Aavas was the exit of founder, Mr. Sushil Agarwal, and post his exit, the stock has seen significant derating, while the earnings have actually held up nicely. But why we continue to hold, again, we believe that the franchise is very, very good. And whilst Mr. Agarwal has left the company, but the team, the senior management team has stayed put. And also the new CEO is now in the job for almost 12 months now. So we believe that team has stabilized. And I think much of the market concerns around the key management personnel exit, I think that should abate as the new team sticks together and keeps on delivering every quarter on quarter good earnings growth. So we continue to hold Aavas in the portfolio. Coming to the new stocks which we added, these are the stocks, cover around 10 stocks which we added since April 2023. Quickly we'll go through one of them one by one. So one is stock which we added is Clean Science. So again, this is in the chemical space, but we added this after the stock had actually corrected by 50% from its peak. So why we added Clean? Because we think, when you look at the return ratio north of 40%, when you look at that historical growth rate, again, revenue growth rate, very, very strong and consistent growth rates. So the Clean Science basically supplies performance chemicals. It largely caters to the niche segment. So there are two important products of Clean. One is called MEHQ and another product is called BHA. Both of these are used in industries, these are industrial usage. For example, one of their application is usage in acrylic fibers, which are used in many industries, whether it is automobile or other industries. And Clean's key competitive advantage lies in the process engineering. So the promoters are all technocrats. They are from UDCT, and they have developed a very, very strong proprietary catalytic manufacturing process. Now, the result of this process is that they are able to generate significantly higher yield than their peers. And one of the way how they manage to generate this high yield is through controlling the effluents or the wastage that comes out. Basically, their input-output ratio is superb. Just to give an example, in MEHQ, their output is for the same amount of input, their output is 60% better compared to the nearest competitor. So as a result, this gives a significant edge to the company in terms of pricing their products, gaining market share, and even after pricing the product competitively, deliver or generate significant operating margins. And second thing we like about Clean is their very systematic approach in product expansion. For example, once they develop their mastery in MEHQ, they forward integrated into BHA, which is nothing which uses MEHQ as an important intermediate. And because you have mastered the manufacturing, the cost structure, the process engineering on MEHQ side, it also gives you a significant cost advantage on the final product itself, because this is one of the important input for. So as a result, they have been able to capture global leadership even in BHA over the years. We think that the company can keep on spotting very good opportunities, and because of their technical engineering prowess, they have ability to develop as cost leader in these products and gain market share in these products. One of the important product expansion which they have recently done is HALS, hindered amine light stabilizer. It's a global $1 billion market, and nobody in India except Clean right now manufactures this product. So Clean inaugurated this factory, visited this factory in sometime in mid-February. So the Clean is the first company to come up with the indigenous manufacturing of HALS. Even though the price of this product is right now similar to other broader chemical spaces right now, a bit subdued. But as things normalize, I think Clean will significantly benefit. So they have gone ahead with their expansion plans, and the management has a very good expansion plan for HALS.
And folks, worth emphasizing that this is a new generation of Indian chemical company, right? Historically, folks remember, the Chinese came and dropped us, right? The Chinese wiped out much of the chemical industry in India through the 90s, through the noughties, by basically dumping on the whole world, including India. They wiped out much of the chemical industry. Clean actually exports to China. One of their biggest markets is China. In their key products, they are the largest exporter into the Chinese market. The Chinese cannot make chemicals as cheap as Clean can. And this is a critical part of our thesis in the chemical sector, that Indian chemical companies have now built enough knowledge on applied chemistry, on process chemistry, and they're operating in a reasonably efficient environment with decent roads, low cost of capital, and therefore they can be competitive in the global market. And Clean is living proof of that. They export into China. 30% of their revenues come from selling into China. In their key products, they're the largest seller in the Chinese market. And you can imagine, right, if more companies like Clean emerge, and all of them will have to go to GMM Pfaudler for their high-end reactors, right? So as the Indian chemical industry builds global competitiveness, GMM Pfaudler will be the go-to player for the top-end reactors. That company benefits. We build a large chemical industry. The government of India is interested in this because the government wants the chemical industry to reduce its dependence on China for APIs. Even today, for the whole world, 80% of APIs come from China. Even for India, 70% of APIs come from China. Active pharmaceutical ingredients come from China. As part of Atmanirbharta, and potentially preparing one day when there might be conflict with China, the government is very keen to make India Atmanirbhar in API. Again, that makes companies like Clean, who make intermediates. Clean makes the raw material which goes into API. a relevant player. And remember, again, for all of this, Alky Amines is your only provider of top-end reactors. So just imagine the potential here, both from a Alky Amines perspective, from a clean perspective, and then Ashwin will discuss further on in your portfolio. He's bought for you one of the largest API manufacturers in the world. Go on, Ashwin, carry on.
Yeah. The second company which we added, this is a relatively recent addition, is Eureka Forbes. I think many of us would be having an AquaGuard in our home. So it's actually a 40 years old company. Why we bought now is because we think this is a new company. So this company used to be part of Shapoorji Pallonji Group for a fairly 40 years. Advent bought stake of Shapoorji Pallonji Group around 2.5 years back. And they have got a very good team here, for example, led by Mr. Pratik Pota, who comes from Jubilant Foodworks and was played a very important role in turning around Jubilant Foodworks during his tenure. So we believe this is a new company under a new ownership, new management, and that can have significant impact, positive impact on the company. One is in terms of their product innovation. For example, AquaGuard, while it has been the first maker of water purifiers in India, but it somehow the product innovation it stifled at AquaGuard. And for example, one important development which happened in the water purifier industry around 12-13 years back was the advent of RO filters. So traditionally, water purifiers used to be UV based, but RO came in. That was popularized by Kent RO around 12-13 years and through heavy hitting marketing as well. AquaGuard was found wanting on that front. We believe that under the new management, the company is much more agile. They have been focusing back on product innovation. And at the end of the day, AquaGuard has very strong brand equity. So I think from our channel checks, what we understood is that people in many instances, they don't ask for water purifiers. They actually ask for, is there an AquaGuard in that? So there is a very strong brand salience that is built around AquaGuard. And we think with the corrections that have been made in terms of product innovations, designs, etc., the company can continue to maintain its market leadership. An important other thing which we think can happen is the AMC. So water purifier is a very unique product in the sense that in case of many of our consumer durable appliances, it is just we buy the product. There is no AMC or annual maintenance associated with it. But in case of water purifiers, we end up taking AMC, right? And it's because the filter has a limited life of say 6 to 12 months. So AMC is a very big revenue generator for companies like AquaGuard. And this is a high margin product basically compared to the product sales. And again, here the company was losing because there's a lot of scrupulous manufacturers of fake filters, etc., which had come in. Again, we think that as the company plugs the gray market proliferation of filters through increasing the campaign, making the consumer awareness, etc., we think this can again add handsomely to companies' revenues and also to the margins because AMC is a very high margin business. And finally, we also believe that the new management, the new promoters, they also have been focusing on bringing the overheads, etc. We're already seeing that in the margins improvements in the last 2 years, but we think that there is still a lot of juice left in bringing down the overheads, etc. at the company level. So, in and all, we believe that we should see very good, healthy earnings growth, for Eureka Forbes. And at the end of the day, we think, again, there is a huge scope for category penetration. So if you look at water purifier, the penetration per household in India is, say, around 5%. Compared to that other consumer durables, those must be in around 25 to 35%. So again, we believe that the increasing penetration, again, to making consumer aware, etc., that itself can also provide good amount of growth to the company.
Folks, worth remembering here, right, that we have bought this at a time when I'm sure all of you know there's a broader consumer slowdown, right? As you're seeing in the GDP growth data, consumption in India is barely growing at 2-3%. I'm sure many of you would have seen HUI's results yesterday, where I think for the third or perhaps the fourth quarter in a row, HUL reported 2% volume growth, right? So why, you might ask, why are we buying a consumer company in a consumer slowdown? The answer is, remember, if you remember, we are building our portfolios around the Wesco thesis, right? We've outlined the Wesco thesis over the last year over several webinars and notes. The Wesco thesis, 5 themes: women, a new educated elite, Southern India, China plus one, and octopus. Octopus being super rich people. These are the 5 planks around which we're building the portfolio. So, for example, clean science is clearly a China plus one play, as China becomes a country that the rest of the world wants to do less and less business with. Efficient Indian companies such as Clean Science, such as GMM Pfaudler, will come to the fore. But Eureka Forbes is a play on the W part of Wesco, right? This is a item that the woman in the house has a big say on. And what our research showed was, in the last 5 years, water filter sales in India have gone up 10x. Right? Water filter sales have gone up 10x. So there was once upon a time where the first thing an Indian household bought was a TV. Then as we got richer, TV, fridge, then TV, fridge, AC, the TV, fridge, AC, microwave. What we are seeing is, as soon as couples now buy a flat or a new apartment, a water filter is a default. And as Ashwin said, many people refer to water filters like by the name AquaGuard. So just like Xerox means photocopy, and Office software means Microsoft Office, water filter means Eureka Forbes, AquaGuard, and 10x growth in water filter demand in the last 5 years. The Shapurji people went through their own challenges 2 years ago, and private equity firm Advent bought it. We spent a year studying how they were running Eureka Forbes. Once we were convinced that Pratik Pota and team were doing a great job turning it around, we built a position. But the kitchen is on fire in India. The women, anything to do with women are earning more money than men, we reckon. We can see from the RBI data that women have more money in the bank accounts than men. We can also see from the RBI data that women have more bank accounts than men, right? So Indian women are now the new force in the economy, and therefore identifying items where the woman presses the trigger has become a critical part of all our portfolios. You'll hear more about this in our other portfolios as well. So Eureka Forbes play on rising affluence and financial muscle of Indian women. Carry on, Ashwin.
Yeah. The third stock is Metro Brands, which actually plays to Wesco theme as well. Metro Brands is one of the most efficiently run retailer. Why I say that, when you look at the store level ROC of Metro, it is close to 60 to 80%. I don't know any other retailer which makes that kind of return on capital employed at the store level. And this is primarily on account of 3 things, 3 drivers, which we believe. One is that the promoter skill in buying the right merchandise and keeping the quality very, very consistent. So Metro has been, I think, founded somewhere in 1950s. So there is a decades, many decades long of experience that the promoter family have in the footwear. And with the course of years, they have built very strong vendor relationships as well. So Metro doesn't manufacture anything in-house. It is all 100% outsourcing model. So as a result, you need to be very, very strict on the quality that is getting manufactured, the design, etc. And by virtue of their presence, a long presence in this industry, they have built a very strong vendor relationship. That art, I would say, skill and relationship, in the recent years, they also tried to bring science in that through implementation of tech initiatives like theory of constraint, ARS, everything. So that has also now got institutionalized the business. And third thing is, very uniquely, Metros has a very unique structure for incentivization of the store managers, where variable plays a significantly higher role than the fixed remuneration. So what we believe is that almost close to 70 to 80% of the remuneration of the store manager is variable in nature. That is dependent upon sales, that is dependent upon customer satisfaction. So as a result, the store managers are incentivized to basically, one is that keep the customers happy, and secondly, have the right kind of merchandise in the store. So anything which is slow moving, which doesn't add to sales, wouldn't basically it wouldn't make sense for a store manager to have that merchandise in the shop. And as a result, the net outcome of this is all of this is that for a typical retail footwear, discount the products that get sold under discount is typically anywhere between 20 to 30%. Whereas for metro, that number is substantially lower at less than 10%. So this straight away adds to their margins, and metro makes and as a result, metro makes significantly higher operating margin despite having a outsourcing model compared to other retailers, other footwear retailers. And all of these very good things that they do on the exhibition front, that has also helped them attract a lot of global brands over the course of last 10 to 15 years. One of the important global relationship which they have is with Crocs. This has been one of the biggest success story in the Indian footwear industry. Metro has run it very, very efficiently, and today, as it's written, almost they make almost as good as Rossi on Crocs as they are at their core Metro and Mochi brands actually. And particularly in the last 2 to 3 years, we are also seeing many new relationships coming into the kitty. For example, FitFlop brand, which is a UK-based company. Metro has been awarded as a licensee of that brand in India. And in the last 2 years, Fila has Metro has onboarded Fila. They have got the exclusive offline licensing rights for Fila in India. And very recently, they also got the right to sell all Foot Locker authorized merchandise in India. We think that this uniquely places Metro, for example, there's a lot of premiumization which is happening in the footwear industry. I think the best-selling footwears are anywhere north of 1,500 to 2,000 rupees. And all of these relationships actually, I think that places Metro in a very strong position in the coming years. The fourth stock is Eicher Motors. Again, this is a premiumization story which we are banking on. So if you look at the Indian two-wheeler industry, if you look at the motorcycle, and if you look at the 350cc contribution within that motorcycle industry, it is only as low as 8%. So we think that as the consumers' income levels rise, as their aspirational level rise, as the financing penetration in the country rise, which has been rising but continue to be good, I think that there is a lot of shift which can happen from lower CC bikes to the higher CC bikes. So Royal Enfield exclusively plays only in 350cc and above bikes. So we see a long headroom for growth because of this premiumization for Royal Enfield. And within that, Royal Enfield has been kind of a monopoly within 350cc and above segment. So they have, I think, 85 to 90% market share in this category. Whilst there are many new entrants in this category over the last 12 months, I think Harley and Hero have come together. Bajaj has tied up with Triumph. There is also new 350cc motorcycle launched by Honda over the last 12 to 24 months. But we believe that Royal Enfield's dominance will continue because, again, there is a lot of aspiration which is attached to the brand. Secondly, they have built a very strong distribution network. So Royal Enfield, if total distribution outlets in India would be close to 2,000, including the studio stores, that will be easily, I think, 10x than the nearest peers. But more importantly, because Royal Enfield has such a huge scale, they sell close to 7 lakh, 8 lakh bikes in a year, that besides the selling income, that also generates a lot of service income for the dealers. And in automobile, a dealership viability is a very important concept because no matter how good your car or bike is, but if the dealers are not able to make profit, no company is able to scale up. And because Royal Enfield has such a huge population of bikes already on the road, they generate significant amount of service income for dealers as well. So as a result, I think this particular thing to replicate for a competitor, again, will take a lot of time. So as a result, we believe Royal Enfield will continue to maintain its dominance in 350cc and above bike market in India. One optionality in the stock, which we think is the export market. So Royal Enfields right now, out of the 8 lakh volume, 7 lakhs come from India itself. Only about 1 lakh come from export markets. Again, what we are finding is that there is a shift which is happening in the export market as well. So if you divide the world into two parts, so there is one developed market and then there is an emerging market. So in developed markets like Europe and USA, the two-wheelers that sell are all 1000 cc and above. So there is not a mid category like 350 to 750 cc, which is Royal Enfield's forte. But what we understand is that there is a move down from these large intimidating bikes, 1000 cc plus, towards this mid segment, both because of affordability, but also there is a new generation of millennials which have come into place who want this little bit smaller bikes. So Royal Enfield has an opportunity to capture this evolve, in fact, create and capture this market mid CC bike in the developed markets. And in the emerging markets, whether it is South American countries or South Asian countries, similar to India, there is an aspirational increase in aspirational level of the consumers, where they are also from lower CC, gravitating towards bigger bikes, where Royal Enfield can play an important role. So again, we believe that over the course of next 5 years, exports can be a big opportunity for Royal Enfield. I don't believe that anybody, broker community or anybody is factoring in big numbers in the exports for Royal Enfield. This can be a big positive surprise for Royal Enfield. And the third part is an often ignored part of Eicher is its commercial vehicle business. So they have a JV with Volvo, where they own 54.4% stake. And slowly but steadily, Eicher is making a mark in the commercial vehicles, particularly in the heavy commercial vehicles. They have always been very good in the medium range, medium trucks, always very, very neck to neck with Tata Motors. But in the heavy commercial vehicles, it is Tata and Ashok Leyland which have been ruling the roost in the Indian market for a very, very long time. But with this improving, changing engine norms, with driver experience also becoming an important part in the trucks, we believe Eicher has a very big opportunity. And with the launch of their new Pro Series a few years back, we have seen their market share almost doubling in the last 4 or 5 years. So, and as we talk today, that market share is still about 8%. So again, there is a lot of room for market share gain, we believe, for Eicher in the heavy commercial space. So these were the reasons for buying Eicher Motors. Quickly moving to SKF. So SKF, again, it's a kind of a leader, largest manufacturing of bearings, not only in India, but throughout the world. We bought SKF primarily because, if I had to just point out one big reason, is to play the industrial cycle. So SKF generates almost 60 to 70% of its revenues from the bearings that go into industrial usage. And as we bet on the private capex cycle picking up pace over the course of next 2 to 3 years, we think that SKF will be a very big beneficiary of this capex cycle. The stock has not done anything, share price has not done anything in the last 2.5 years. We believe that as the earnings prospects improve in FY25, we should also see a bit of a P re-rating that should help SKF. This was the primary motive for buying SKF. But leaving that aside, it's a good company. It makes very good ROC, has got a very strong technology focus from the parent. And as is happening in many other companies, many other industries, the global parent is also recognizing India as a very big, very important geography. As a result, there is a lot of focus of the global parent in setting up capacities in the industrial side in India. So far, they have the automotive capacities, but industrials, SKF was largely buying from the group entities through the world. But what we understand is that there is a focus of the parent towards localization of this industrial bearings capacity also in India. And we believe that SKF will definitely benefit from this trend. And Tube Investment, which has been one of the, I think, very good stock performers in the recent history in Indian markets. We bought Tube primarily because of 2 reasons. One is that because of their excellent operational efficiency that is visible in their existing business, whether you take TI, auto component business, we are seeing the margins improving significantly in the recent years, primarily coming from reduction in the overheads, etc. So they are the masters of basically efficiency initiatives, Kaizans, etc. And that is also visible in the way they turn around CG Power since their acquisition. So we believe that that is an important, they'll continue to do that. But also we are betting in Tube is on the optionalities in the stock. So Tube has made a foray into very important industries, whether it is electric vehicles, medical equipments, pharma, CDMO, etc. And these all of these industry are multi-billion-dollar TAM markets basically. So we are betting that as Tube has historically been a success in many of these ventures that is entered into, it should also be able to do well in many of these new industries. So while on a pure P basis, the stock may look a bit expensive, but if you build a meaningful revenues, earnings from these industries over the course of last 4 to 5, in the next 4 to 5 years, we think that there is still a big room for upside in Tube investment.
And just to sort of quickly, I think Ashwin explained that, because I think for a number of our investors, they'll be asking, why is Marcellus investing in a conglomerate? So folks, roughly Tube's market cap is $8 billion. Out of that, remember, they own 57% of CG Power. So the CG Power stake itself will be $5 billion, right? So the CG Power stake itself will be $5 billion. So you're left with $3 billion that you need to figure out. Tube's auto ang business is a profitable business. I think ROCs are around 20%. It's a market leader in its market, especially in South India. They have a decent cycles business, that probably number 2 or number 3 in the cycles business. They also own 70% of Shanti Gears, or perhaps 75% of Shanti Gears, which is separately a listed company in our Little Champs portfolio. So if you add all of that up, you'll get to around $500-600 million on that itself. So you've roughly now covered off 6 billion out of the 8 billion valuation. So you're left with 2 billion to justify, right? Now, can you justify the $2 billion of Tube's valuation on the new investments that they're making in EV trucks, EV three-wheelers, and EV tractors, right? So in EV, they were triple play: trucks, tractors, and three-wheelers. And as Ashwin's also written, they're building a medical equipment business and a pharma CDMO. Pharma CDMO is like Divi's Lab, right? Our reckoning is you can easily justify that 2.5 billion just on the auto business alone, but the 3 EV businesses. If you look at a firm like Ashok Leyland in India, or if you look at Tata Motors' trucks business, that itself will allow you to comfortably justify a $3 billion valuation for Tube's EV trucks business. So you might say that, look, EV truck nahi chalega, EV tractor bhi nahi chalega, EV three-wheeler bhi nahi chalega. That we'll find a little hard to believe, given the Murugappa Group's track record in building and scaling profitable businesses. The fact that out of 5 new ventures, 3 in EV, 1 CDMO, and 1 in medical devices, out of 5 new ventures, none of them will work, will be a little far-fetched. And therefore, we believe on a sum of the parts valuation, the current Tube market cap can be quite easily justified. Majority of it coming from CG Power. In CG Power, remember, they've also starting a semiconductor business beyond their market-leading motor control business and the strong T&D, transmission distribution business. So this is an industrial group where capital allocation is good, efficiency levels are improving with each passing year. And then the most exciting part, the thrust into not car wala EV. They're not doing EV that is for leisure. All of their EV forays are commercially focused, right? Three-wheeler, trucks, and tractors, right? They're focused on EV where there is a payoff, where there is a commercial payoff. And given that the same group, the Murugappa Group, also owns Chola, the third largest truck financing business in India, is part of the Murugappa Group. We think there's some exciting synergies there. Back to you, Ashwin.
Yeah, thanks. The next talk is Trent. Again, I think many of you must be knowing the story of Trent. Basically, I have to point out one thing that boils down the competitive advantage of Trent, that is the supply chain, getting the right merchandise and at a very fast pace to the customer. Basically, have the relevant merchandise in the store. So that in place ensures that there is a very good inventory turns that the company does, and customers also keep coming back to to whether it is Westside Store or Zudio stores. Trent has 3 years back, it was largely a Westside success story in Trent. But over the last 3 years, Zudio has actually emerged a much stronger success story for Trent. It has completely disrupted the low-priced apparels. Again, Trent on face, when you look at the P itself, it will look expensive. But we believe that there is still headroom, a lot of headroom for Westside stores. It can easily double the network of Westside stores from the current levels. It can easily more than double its network of Zudio stores from the current levels. In other words, basically, we believe that the earnings growth of the company can remain very, very healthy for the next 4 to 5 years. There is also, I think, Star Bazaar, which has been turning around in the last few quarters. We believe that the market is not paying adequate attention to Star Bazaar. We believe that Star Bazaar will be a very profitable franchise for the course of next 3 to 4 years. That can also significantly add on to the earnings of Trent. We believe that currently it is not been kind of built in any of the street estimates. Again, this can positively surprise the street on Trent. Moving to RHI Magnesita, it's a supplier of refractories to the steel industry. Again, we believe that to pay the steel cycle, refractory is a better way instead of investing in steel companies, primarily because unlike steel, where volumes tend to be very, very stable, but pricing, because of the global factors, tend to be very, very volatile. In case of refractories, pricing doesn't vary significantly. It's a very, very stable industry because it plays on the volumes of the steel rather than the price of the steel. So it's a better way to play the steel cycle. And within that, RHI Magnesita is by and far the dominant player, particularly in the basic oxygen furnace segment. So there are 3 broad processes in steel making. One is the melting of the iron ore in a blast furnace. Second is the steel making, whereas this molten metal is actually converted to steel. And then there is a flow segment where this molten steel is actually transported to be casted into longer flat products. So the middle segment, which is the basic oxygen furnace, that is where most of the refractories, particularly the magnesium-based refractories, of which RHI is the champion, these are used. Almost 50% of the refractories are used in this middle process of basic oxygen furnace, where RHI actually has about 30 to 35% market share in India, as well as globally. There is a strong focus of parent on RHI India. So that is evident in terms of all latest technologies that is being developed in RHI Austria that is being transferred to India. And more importantly, we see a lot of reinvestment in the business in the last 5 years. For example, RHI used to have many unlisted companies in India. All of this has been consolidated under RHI listed Indian company now. They also plugged important product gaps. For example, they were not very strong in the flow segment. So they acquired a company called Hi-Tech around 2 years back, and they have plugged that gap on that front. And also around 12 months back, they acquired Dalmia Refractories. By acquiring Dalmia, they got an entry into cement industry, which is also a very big end user industry of refractories. So they got an entry into Dalmia Refractories. And basis the announcement from Tata Group, Jindal, and other steel players, we think that there should be a very good uptake in the steel demand over the course of next 2 to 3 years. And RHI is our candidate to play that cycle. And last 2 companies,
folks, this too is a China plus one player. Right? Remember, refractories are essential for steel plants and cement plants, right? So effectively, what a refractory is doing is when a steel plant's furnace is going to 1500 degrees Celsius, the walls will get damaged. So the refractory material, RHI Magnesita's output, is used to line the walls of the furnace. So this is required globally. Historically, China was a big exporter of this around the world. As we discussed, as global companies gradually lose faith in the Chinese, and as India becomes an efficient manufacturing hub, firms like RHI are bringing their export business to India. So RHI Magnesita, the Indian listed business, not only will makes for the Indian market where it has dominant market share, but it's also going to increasing the global exports will be sourced out of India, and therefore you get a double play. The capex cycle is on in India. As you'll be reading in the newspapers, steel demand is growing at 12-13%. I think Adani's already announced steel capex. The Jindals have already announced steel capex. So we're in that part of the economic cycle where steel demand is booming. New steel plants are going to come up. Every steel plant will need this refractory material. Increasingly, that business will go to RHI Magnesita.
And one recent addition has been Narayana Ridalaya. Again, why we bought Narayana was because we think it's a very efficiently run hospital. So we did a lot of primary data checks, and we came back with one important that Narayana is way better than other hospitals in terms of their process efficiency, in terms of, for example, the way they are able to sweat their assets, whether it is operation theater or digitization of the patient records. So as a result, Narayana's cost structure is significantly lower than other hospital peers. And what this gives Narayana benefit is to price its product, at least for the affordable population, very, very competitively. So over the years, they have been a very strong brand, particularly in the cardiovascular segment, and in the recent years, even in the oncology portion. And another good thing which we like about Narayana is their very prudent capital allocation. So they're always expanded in their core geographies or the adjacencies around it. For example, Bangalore is one of their core market. Similarly, Kolkata is another. So whatever expansion they have done in the past and what they will be doing in future is all around this their core geographies. Again, which we think is very, very prudent. And another important driver of Narayana's earnings is their hospital in Cayman. So Cayman is one of the country in Caribbean. So Narayana they entered Cayman primarily to serve the US patients, basically. Instead of getting treated in US at a very high cost, come to Cayman basically and get treated at a fraction of the cost. But what eventually this ended up being is that they served largely the population of Cayman. But the good thing is that there is virtually no competition in Cayman. So there is one big public hospital, and then among the private hospital, Narayana is the only one, at least in the biggest category. So as a result, they got this first mover advantage in Cayman. And over the course of last 4 to 5 years, they have been able to significantly improve their margins as the utilization rates have all gone up. They are able to deliver a very good growth from Cayman. So again, here we think that the next 4 to 5 years, as the cycle in hospital industry should do well, Narayana should be a good beneficiary of that. And finally, coming to Motilal Oswal, why we added this, we again think that that there is a turnaround which is happening in this company. While the broking business is fairly stable, and it will fairly stable, it has been doing good, and it will continue to remain a very good beneficiary of the financialization of the savings that we have been seeing on a structural basis over the course last 5 to 10 years in industry. But where the turnaround is happening is on their asset management business and in their home finance business. So their asset management business has seen a turnaround since the last 12 months. With the new CIO coming in, and as we speak today, majority of their funds are delivering alpha, which we think as we go forward should result in a strong inflow to them, as well as good performance fees which should accrue to the bottom line. And secondly, on the home finance bit, obviously they were struggling around 5 years back, but over the course of last 3 to 4 years, they have stabilized the business. And we believe that as we go forward, they will now press the accelerator on the home finance. They have been laying low because they wanted to bring a stability to this businesses. But now that business has stabilized, we believe that they will press the accelerator on the home finance front, and that should also add significantly to income as well as the bottom line for Motilal Oswal. In other words, we believe that next 2 to 3 years will be very good for the firm. And finally, quickly, I think the way forward is we believe again. Obviously, we have exited some companies which we believe that chances of revival in earnings have been bleak. In their place, we have got the companies which we discussed, where we are very confident about their earnings delivery over the course of next 2, 3, 5 years. So we have made the necessary portfolio changes, but we will continue to make. It's not that we will rest now. We'll continue to monitor every portfolio company at microscopic level. Wherever we feel that the investment thesis is not playing out, or we have lost conviction on their earnings, we will move out of that stock. But we will be much more agile than what we were around 2 years back. Secondly, we believe that FY25, for example, some of the companies which we discussed, their earnings in FY24 was not great. We see there is a revival which will come into play in FY25. Hence, from being a 10% earnings compounder in FY24, or at least till 9 months December 23, we should move back to 20% earnings growth for the portfolio in FY25, which we will be very confident about. So as a result, we see again, and given that P now has derated, we are the portfolio median on average or weighted average P is close to 37, 38, which this kind of portfolio, which we find is very reasonable. So combine that with the current P, which we think should translate to healthy returns for the portfolio over the next 2 to 3 years. We'll stop here. I think I will take the Q&A now.
Great. Thank you. Thanks, Ashwin. Thanks for a fairly detailed views on the stocks. So given both of you have calls at 6:30, we'll try and take questions which haven't been answered already. The stock-specific questions, given the details that you've given. We'll focus on some of the philosophy elements. I mean, folks who have any further questions, please put it as ever. If we are not able to answer within the time, we will get back to you individually and share answers to that. But we'll try and answer the philosophical questions where clients have rightly acknowledged the change in the approach and actually commended that we've acknowledged the fact that right at the outset, valuation was an issue with rising giants. Just to clarify the questions around, when we set out, we always said that we look at intrinsic value as opposed to P multiples. Now that we're saying in late 2021, the P multiples were high. Does that mark a change in our approach to valuations, or is there another way to look at it?
Look, I mean, we still focus on intrinsic value. We wanted to summarize the fact that we wanted to sort of encapsulate in one slide the fact that Jan 22 was an expensive time to enter. Right? With the benefit of hindsight, had we known that Putin will attack Ukraine, double oil prices, double metal prices, and interest rates up by 5%. Had we known that, we wouldn't have kicked off RG then. But with the benefit of hindsight, we're all very wise. Real time, we did not know. We thought that the high valuations of Jan 22 or December 21 could sustain. Vladimir Putin proved us wrong, and we wanted to highlight that in a nutshell. If you increase rates by 5%. If you increase interest rates by 5%, any company whose valuation is based on future cash flows, right? Remember, barring a company like, say, Coal India. A company like Coal India, you're paying for the coal inside the ground, and therefore there isn't that much of a discounted cash flow to be done. Barring that, any other decent company, you're saying I'm paying for the future cash flows. Even Marcellus's own valuation is based not on how much money we manage today. It's based on how the business will grow in the years ahead. Similarly for, say, a Dr. Lal or a Divi's lab. Now, if a valuation is predicated on future cash flows, which is what all good companies' valuations is predicated on, future cash flows, if you increase the discount rate by 5%, naturally the valuation drops. The better the company, the greater the future, the further into the future you're looking at cash flows, the bigger the drop in valuation, right? And all our portfolios suffer. We invest in high quality companies. By definition, folks, if you invest in high quality companies, the company is going to earn cash flows far into the future. And by definition, in a rising rate scenario, those are the companies that will get hammered. So we got hammered. We got hammered for 15 months from Jan 22 to March 23 in all our portfolios, right? So I sat in this room Ashwin sat at his desk. We all got plastered for 15 months. Did we change our valuation philosophy? No, we didn't. We said we will carry on looking for high-class companies. We are not going to invest in PSUs. We're not going to invest in crony capitalism. We carry on looking for high-quality companies with dominant franchises, clean books of accounts, the ability to reinvest large sums of money back into the business and grow the business for many years to come. And as the valuation hammering, as the portfolio hammering abated exactly a year ago, as the portfolio hammering abated a year ago, we started repairing the portfolio. We started looking at which were the companies that have been beaten up the most, both in valuation and fundamental terms, and looking for attractive replacements. Ashwin's talked to you through those replacements. The investment philosophy remains: look for clean companies. There aren't lots of clean companies in the country. Look for good capital allocators and look for dominant franchises. Buy them, stay patiently invested, and if you can avoid a situation like Jan 22, where after a 2-year run up you then enter a war, then try to avoid that situation. Again, as I say, with the benefit of hindsight, everybody is very wise. Real time, going into Jan 22, we didn't have any way of knowing that war would break out. And since then, it's not as if we have suddenly started buying PSUs or crony capitalist or low quality companies. The quality of the portfolio, as you can see on the screen, is impeccable. And it's borne fruit. It's borne fruit in the last 12 months as the portfolio repair job has started kicking in. Now, let me quickly quantify. In the interest of time, let me quantify how long it will take you to get back into the black. So assume for a minute, you're at -5%, right? -5 CAGR is where you are. So remember, if you assume you've been invested for 2 years, we need to rise by another 10%. So -5 times 2, you need to rise, the portfolio value needs to go up by another 10% for us to get you back to neutral. Given the progress made over the last 12 months, if we're able to continue progressing at the rate that we've done over the last 12 months in RG, in another 5 to 6 months, we should be able to get you back to neutral, which is another way of saying if these companies continue to grow fundamentals, grow earnings and share prices by around the 20-25% mark, in another 6 months, we should be able to get you back to neutral.
Thanks, Saurabh. Just a corollary on the valuation piece. There's a genuine question from a client who's saying that, look, I can't forecast my own free cash flow for the next year. How do you guys get confidence in your ability to forecast free cash flow for these firms to establish an intrinsic value? As we've seen, some of these businesses have gone through ups and downs on the earnings itself. How should we look at it in terms of our confidence in our ability to forecast?
Right. I think looking at the screen, broadly speaking, if you look on the screen, there are 3 types of companies on the screen. There are 1/3 of the companies are selling products or services which are reasonably close to essential for day-to-day life, right? So we've discussed for many years now Divi's Lab and its APIs. So 75% of the world's naproxen, which is the key API for painkillers, 75% of the world's naproxen comes from Divi's. And therefore, doesn't matter whether COVID is happening, the Ukraine war is happening, the Israel-Iran war is happening, whatever is happening, the world needs Divi's Labs products. And therefore, quadrupling the position in Divi's and CCP a year ago, or building a big position in Divi's for the first time for RG. RG built its position in Divi's, Ashwin, roughly a year ago, right?
Yeah, February 23.
Yeah, so 13 months ago, we built a big position in Divi's. Why could we do that? Because we said Divi's ka product ka demand to guaranteed hai, right? Divi's makes out of the world's 20 largest APIs. Divi's is the leader in 10 of them. Product demand has high visibility. Company is clean, company is dominant. And therefore, when the share prices had got hammered in the 12 months running up to March 23, Ashwin didn't hesitate to build a big position in Divi's. Neither did Rakshit hesitate in CCP, and that's borne rich fruits. So that's the first type of company where the product demand is pretty sticky, pretty stable, and therefore you can ride on that and build positions, especially if the companies come off by 50%. Dr. Lal, very similar situation, by the way. Dr. Lal had fallen by 50% 18 months or so ago, and we hung in there, and it's since borne fruit. The second type of company is making a product which is not essential, but neither is it a B2B cyclical business, right? So if you look on the screen, an Eicher Motors or a Trent, they're not making an essential product, right? I don't think I can say a Trent trouser. I'm talking to you wearing a West Side trouser, which is 999 rupees. I could buy a trouser which is not West Side, and I could buy a two-wheeler which is not Eicher Motors. But these companies are stable franchises. They're not selling essentials, but they're stable franchises run by promoters with a strong track record of generating return on capital above cost of capital. So Noel Tata at Trent and Siddharth Lal at Eicher, they've done this for long enough for you and me to believe that they will be able to carry on running high quality, well-run businesses for a long period of time, right? So Divi's Lab का product essential है. Eicher Motors का product in that sense is not essential, but the track record that Siddharth Lal has built since he started running the business in 2008, the track record he's built in Royal Enfield and in the Volvo Eicher piece suggests that this man will carry on doing a good job in the years to come. Ditto with Noel Tata at Trent, right? And the third type of business on the screen, the third type is the one which has a degree of cyclicality, right? That's the hardest of the businesses on the screen. So an RHI Magnesita is a supplier to the steel and cement industry. Steel and cement is 100% cyclical. Clean Science is a supplier to the chemical industry. Chemical is a cyclical industry. Grindwell Norton supplies abrasives to the auto industry, to the machine tools industry. Those are cyclical industries. Now, how on earth are we getting the conviction to invest in firms like Tube, like Grindwell, like Clean Science, who are suppliers to cyclical industries? The simple fact is, we believe these cycles, the cycles that Clean is supplying into, RHI is supplying into, Tube Investment is supplying into, those cycles are on the uptrend. There's good reason to believe that after a decade, India is entering an upswing in the capex cycle. This is the private sector capex cycle. We're not so interested in the government capex cycle. That's a different story. After a decade, India is entering an upswing in a private sector capex cycle. There's good data to suggest that. Discussions with promoters, discussions with business people across the country suggest that we're entering the upswing of a private sector capex cycle. And RHI Magnesita, a Tube Investment, a Grindwell Norton should allow us to profit from that. So I admit the job is hard. That's why we exist. That's why all of us had far more hair 5 years ago than we do today.
Just to add to that, folks, of course, we do recognize the limitations of forecasting in the first place, which is why we use our margin of safety and sustainability approach, where we give ourselves room to err on that side. Neither us and our ability to forecast, nor the managements and the businesses are living in a certain world. It is a probabilistic world, and hence the margin of safety approach. The second change people have noticed in the philosophy is the diversification, Saurabh and Ashwin. I mean, it relates to the buy and hold and churn as well. So the question is that a reflection of the limitation of the earlier stance? Whatever happened to our buy and hold approach, low churn, concentrated portfolio? How should they think about it?
So I don't think there's any desire to move to what should I say, the opposite of buy and hold, which is buy and sell, right? I don't think Ashwin has become a trader. Even today, he's buying one stock a month. Now, if you guys meet other fund managers, and I'm happy to introduce them to you, they buy one stock a day. Ashwin Shetty buys one stock a month. So in that context, in the context of Indian fund management, this is still pretty low churn. Where I think we went off track, and again, I have to put my hand up for a big part of the blame. Both in LCP and in RGP, we focused very narrowly on a couple of themes, specifically pharma and specialty chemicals, and the domestic consumption theme, right? Both of those themes bombed on us. The pharma piece, the pharma and specialty chemicals theme had a double hit. Firstly, through COVID, specialty chemicals and pharma did exceedingly well. So as COVID abated, earnings came off, and then 2023, the Chinese decided to dump on the whole world. The Chinese government gave Chinese chemical companies a range of incentives to make chemicals below cost and sell it across the world. So we got a double whammy from our fascination for pharma and spec chem. As Ashwin has explained, we've exited some of them. So, for example, Galaxy Surfactants is out of the portfolio. But on the other hand, there are pharma spec chem plays which stay in the portfolio. GMM Pfaudler stays in there, and Alky Amines stays in there. These are market-leading franchises with great fundamentals, and we have to be patient with them. And Divi's Lab we added. I don't think when we bought it we knew that was the bottom of the share price curve. Luckily, it turned out for us that we added Divi's Lab right at the bottom of its correction, and since then it's recovered nicely. So the first, I think, mistake we made was we over-focused the portfolio on two major themes. As we learned from our mistake, and as you guys are seeing, this portfolio is far more diversified. It has some domestic consumption, Trent and Metro shoes. It has some pharma spec chem. It has some domestic healthcare, Divi's Lab, Narayana Healthcare, Dr. Lal and Narayana Healthcare. It has capital goods and the capex cycle, RHI Magnesita, Tube Investments. So we are trying to make these portfolios more diversified so that if one theme, say chemicals, gets beaten up, or say the capex theme gets beaten up, right? If one theme gets beaten up, the whole portfolio doesn't burn up, as it did both for LCP and for RGP through the post-COVID aftermath of 2022 and then through the Chinese dumping of 2023.
Fair enough. Just the last piece on the philosophy, I guess we'll just have to wrap up with that question. Historically, we've looked for stability and consistency in historical track record of fundamental performance in businesses. Some of the stocks on the screen have had a little bit of a patchy past, you can say, or a checkered past. Extreme case is something like a Eureka Forbes. Looks like a clear turnaround story. Does that also mark a change from the past in terms of we're happy to look for companies or stocks with a little bit of chink in the armor in pursuit of valuation comfort?
I'm glad it appears like that to whoever is asking the question. I'm glad it looks like that because it suggests that we are not one-dimensional. A lot of people criticize us for saying being one-dimensional, but to be honest, we remain as scared as we always were of companies with dodgy management teams and weak track records. Eureka Forbes, to our mind, was reasonably easy. Eureka Forbes, the product itself, AquaGuard, as Ashwin explained, it's been a market leader for 40 years. Even today, it is the almost unchallenged market leader in Indian water filters. The number 2 is Pureit from Unilever, but it is and especially in general trade, it's the unchallenged king of, it's the Asian paints of water filters. AquaGuard is. Under Shapoorji Pallonji, for whatever reason, they weren't able to take the franchise forward, right? Now, you guys will have to ask them what happened there. But the market share remained solid. The dominance of general trade remained solid, and we knew that for many years. So when Advent acquired it from Shapoorji Pallonji 2 years ago, we said, "Ye to bahut interesting hai." That class franchise, but not run with great dynamism. Now acquired by private equity. Private equity naturally will want to make money in 5-6 years. Then when they hired Pratik Pota, who we know as a good guy, we knew Pratik had done a good job at Jubi Foods, at Domino's. And we also knew some of his friends from Unilever who rated him very highly. We said, this is really interesting. Good franchise. Now class CEO. Even then we said, for a time dete hain. Let Pratik settle down. Let's watch how he performs. So once Pratik had spent a year turning it around, we went and visited lots of stores where the product is sold. We met some of their ex-staff members, and we figured out that Pratik indeed is bringing the franchise around. Top line growth had been close to nil for a decade. In spite of the powerhouse franchise, top line growth was nil. Pratik revived that, and then costs were being taken out. This is a business with gross margins of 60%, operating margins less than 10%. So enormous scope for cost takeout, massive jump in profitability we felt. So it was quite easy. Dominant franchise, the most powerful water filter franchise, good CEO, a clear traction in reducing cost and increasing top line. And therefore, we said lots of money to be made here. So thanks, Pramod. I think we'll have to
Thank you. There's one more question I'll answer on your behalf, so you guys can. The question is around our research capability. Given that we've added so many stocks, does that dilute our ability to research these stocks in depth? And I can vouch our team is working doubly hard, particularly Saurabh and Ashwin. I've seen them run across the country, checking out channel checks by themselves in every nook and corner. So suffice to say, there's no compromise in terms of the diligence on these stocks. We are careful, and just to reiterate, we have all our investments, our personal investments, in the same portfolio, so we won't compromise on that. But nonetheless, thank you. Thanks for dialing in. We'll try and respond to each of you whose questions haven't been taken, and hopefully you will get that addressed. We will be in touch with you with the next webinar shortly. Thank you. Thanks, Ashwin. Thanks once again.
Thank you, everybody. Thank you.